All right, let's talk about Crimson Wine Group. We've got a luxury wine company here, and they are facing a market that's, well, it's in decline. But instead of playing it safe and hunkering down, they made a really bold, kind of counterintuitive bet on their future. So let's break down this high-stakes pivot.
And this really is the central question, isn't it? I mean, with sales dropping and unsold wine literally piling up, why on earth would a company decide to go deeper into debt just to expand? It seems to fly in the face of all business logic, but trust me, there is a fascinating strategy at play here.
You know, to really understand this gamble, first we have to get a feel for the immense pressure Crimson was under. 2025 wasn't just some tough year for them. It was basically a perfect storm of financial and market headwinds.
So first up, the top line. Their total sales dropped by a whopping 11%. Now, in the world of luxury goods, a double-digit fall like that is a major red flag. It's a sign that even high-end consumers are starting to tighten their belts.
A huge piece of that drop actually came from their international markets. You see, trade tensions, especially with Canada, brought shipments to a halt for part of the year. And poof, that wiped out $1.6 million in export sales. It just goes to show you how vulnerable a business like this is to things that are completely out of its control. Now, take a look at this. This chart shows what happened to all the wine they just couldn't sell. The company had to write down, which basically means devalue, $2.1 million worth of their inventory in 2025. That's more than double the year before. And look, this isn't just some boring accounting entry. This is a financial admission that they have a lot of wine just sitting in a warehouse with nowhere to go.
Oh, and it gets worse. They also wrote off $1.3 million in something called goodwill. So goodwill is basically the extra money you pay for a company's brand and reputation when you buy it. Writing that down is management's way of telling investors, yeah, those deals we made in the past, they're not worth what we thought they were anymore.
Okay, so let's recap. Sales are down, inventory is stacking up, past deals are going sour. You'd expect a massive loss, right? But here's the crazy twist. They actually reported a profit. How is that even possible?
The official number they reported was a net income of $613,000. I mean, it's not a huge profit, but hey, it's in the black. So on the surface, it really looks like they managed to weather the storm. But when you dig into where that money actually came from, well, the story changes completely. And here's the kicker. They got $4.1 million, not from selling a single bottle of wine, but from insurance payouts and legal settlements tied to those devastating wildfires from a few years back. And that really says it all, doesn't it? Their core business, the whole making and selling of wine, that part actually lost millions. The only reason their books showed a profit was because of what analysts are calling disaster-driven revenue. It's basically a financial mirage, and you just can't run a company on that. Which, of course, brings us to how they responded. Knowing that their main business was bleeding cash, they didn't pull back. No, they did the exact opposite. They made a massive $35 million bet on the future. So right after this absolutely brutal year, in early 2026, they spent over $35 million to buy the Raeburn wine brand. In a market that's shrinking, they decided to get bigger. And the first question you have to ask is, how in the world did they pay for it? Well, this chart here says it all. The vast majority of that purchase, we're talking $29 million, was funded by taking on new debt. They essentially mortgaged the company's entire future on this one single acquisition. And just look at the impact of that. Their total debt skyrocketed from a pretty manageable $15 million to nearly $45 million, practically overnight. This just dramatically increases their financial risk. If this deal doesn't pay off, and pay off big, those new debt payments could become a very serious problem. So why would they take such a huge risk? Well, this quote from the source analysis really nails it. It's an attempt to buy growth when it's not happening organically. They basically made a strategic decision that if they couldn't create growth themselves, they were going to go out and buy it. But hold on, there's a third piece to this puzzle, and it's just as important. While they were making this giant financial bet, they were also investing a ton of money in sustainability. And trust me, it's more connected to the bottom line than you might think. I mean, they've gone all in on this stuff, what we call ESG. They're aiming for net zero emissions. They're getting all these certifications, and they're upgrading their vineyards to be tougher against things like drought and fire. These are really serious and really expensive commitments. Which, of course, leads to the big question. Is all of this just good PR? You know, a way to look good? Or is there a cold, hard business reason for doing it all? The answer is a definite yes. Remember that disaster-driven revenue that created their fake profit? Management knows you can't run a company on insurance claims. So by investing in things like forest management and water resiliency, they're not just being green, they are actively protecting their most important assets from the next disaster. It's a long-term play to build a more resilient and ultimately a more profitable business.
So when you put all the pieces together, you can see this clear three-step strategy taking shape. Step 1, acknowledge your weakness, by writing down those struggling assets. Step 2, bet big on growth with a massive debt-fueled acquisition. And step 3, build a competitive moat around your business by making it more resilient to climate risk.
Which leaves us with the final million-dollar question. Is this a brilliant masterclass pivot that's going to position Crimson to thrive while everybody else struggles? Or is it just a desperate, high-stakes gamble that has loaded the company with way too much debt at the absolute worst possible time? I guess the next few years are going to tell that story.
This analysis was brought to you by HDIN Research. You can visit us at hdnresearch.com for more independent insights.